Hey guys, it's Eric with Low VA Rates trying to debunk a myth that we hear so often, and that is ARM loans are bad, or adjustable rate or variable rate mortgages are bad. Now, after the 2008 mortgage crash, I know that's quite in the distant past right now, but if you were around back then and you were at the age of a young adult or an adult, you certainly remember 2008, 2009. Shortly after that crash, adjustable rate mortgages or ARM loans were given like a super bad rap. The idea that they are all automatically bad, however, that is a myth, and I'm here to debunk it. Now that you know ARM loans aren't always bad, I want to quickly explain why this myth even exists in the first place. For starters, the ARM loans of today look nothing like the ARM loans pre-2008. These more modern, or safe, if you will, ARMs, often referred to as hybrid ARMs, are safer because they usually have a period of time where the interest rate is fixed and it cannot adjust. Typically, you're going to see these for 3 to 5 years on VA mortgages, but there are conventional loans that have fixed rate periods for 7 or even 10 years. Now, with that in mind, I want to share a couple of specific situations where ARM loans are really good and should be highly considered. Situation number one, you know that you'll be selling your home in the recent or in the near future, I should say, especially in that 3 to 5 year range. If you're still serving active duty in the military, you know you'll typically get new PCS orders after just a few years. If you buy a home and then you're planning to sell it when you move, an ARM loan might be a great way to lock in a really low rate, much lower than fixed rates at the time, without the risk of that adjustment period. Meaning, oh, what happens if I'm in this loan after year 3 or 5 when it can start to adjust up or down? So if you know that you can take that uncertainty out because you'll be moving, you don't have to have that anxiety or that fear. Situation number 2, you plan on refinancing your home in that same short timeline, 3 to 5 years. Just like selling, if you plan to refinance your home before that fixed rate period ends, you'll likely be able to enjoy several years upfront of an extra low interest rate, which means lower payments. If you refinance into a fixed rate loan before the end adjusts, don't worry about the risk of that rate going higher because you won't be in that adjustable rate loan or that hybrid loan any longer anyhow. So if you have more questions about the VA hybrid ARM loan, which I love, by the way, I always try to put my own life into perspective here. I'm not a veteran. I do have a hybrid ARM. It's a 7-year hybrid ARM loan on my primary home here where I live. It's been amazing. I do know it will be adjusting upward soon, so I will likely be refinancing before that day comes. That's what you need to do if you're worried about an ARM loan adjusting upward. Give us a call, though, no matter what your question or concerns are regarding adjustable rate mortgages. They are not bad. Most real estate professionals and high wealth individuals in this country tend to use adjustable rate mortgages in real estate. It might be a very smart move for you. Give us a call. We'd love to help you out.